Hi, it's Josh Houchins here again. Today we're moving on to section 4, just a review. I wanted to go back and cap over some of the other sections that we've already done. With this being said, that most of these videos are just an overview of exactly what we're teaching, the literature, and our website, which should be up in the next 2 or 3 weeks, has all these documents that I'm speaking about or telling you about that you can download and use them. I'm not going to sit here with a dry erase board and go over formula after formula. I'm just giving you a brief rundown of my opinions and my strategies, and you'll be able to get this documentation from either my binder of how to accomplish these deals, or through the website. The whole course is set up in the binder that gives you actually detailed information. And if you happen to lose one, or you want it in an Excel format or a Word format, or whatever format you're using to get these deals processed, obviously they'll be available to download. So section 4 I want to go over is rental properties. This is one of my personal favorite sections. I am a big advocate for obtaining a rental portfolio, whether it's commercial property or residential property. And I'm going to go over a few ways to accumulate properties, also how to get capital to do these deals, and also how to use other people's capital to benefit yourself and getting cash flow through them. I'm not personally not a big stock bond guy. I would obviously recommend you counsel or consult your financial advisor or your CPA, depending on your situation, as far as your tax obligations. But for me, rental properties build a income stream that I like to call passive income. Passive income is income that you're getting from money that you've invested in something. The bank's going to give you 0.75%. Your stocks and bonds, whatever they might yield, 5, 10%, sometimes more, just depending on how savvy you are in that business. Me personally, I don't quite understand the stock market as well as I do the real estate market, so that's why I'm more heavily leveraged in the real estate market. I feel it's a solid investment. It's tangible. It's not just a piece of paper and a number of shares you own, and if the market crashes, you're losing money. If you hold on to your property over time, it'll be worth it. There's an argument from the opposite side of that as well too, that certain mutual funds are safely secured, and over time they earn money, which they do. But I like to get a check every month. And basically passive income, and the whole point of building a rental portfolio is to build this passive income. And this would be income that once you build your portfolio big enough that you will be able to have enough money coming in every month to pay your bills, to live, food, whatever expenses you acquire in your personal life, that will allow you to have passive income, and that gives you financial freedom. So if you're doing some flips and rehabs, new home construction, or whatever other kind of real estate investment you're doing, if you have a solid base of rental income and passive income that covers your monthly expenses, obviously you want to sell your properties as fast as you can, but this helps in the cash flow, as I spoke before, which is the crucial part of a real estate business, is having cash coming in on a regular basis. So the difference in a real estate business versus, say, a restaurant or a contracting business, or apparel business, or whatever type of business you're in, is you have customers come in every day and they pay. You give them a product, they pay. In a real estate business, they don't come in every day. If you could have a house closing every day, that would be great, but it's going to take you time to get to that point, or even have a closing every month, or 2 or 3 every month. So by accumulating rental properties, that generates some cash flow coming in every month, and it helps you with month-to-month expenses that you're going to have in your everyday life. So let's jump right in. Basically, these are a couple different strategies that I use to get rental properties. One big thing here after 08, 09, and the banks decided not to lend, and they've cut back on regulations of how many individuals can borrow money, how many properties an individual can borrow from. Different lenders have different regulations on that. A lot of them have 4. They'll give you 4 loans on a secondary residence or an investment property. To me, that's not enough. So You can use your 4, refinance them back out to generate some equity to buy another one. A strategy that I like to use is when I flip a property, I'm going to get a chunk of money back. I try to take some of that profit and put it into a different pool, and this pool allows me to buy property, whether it's cash or at least put a down payment on it. The good thing about your standard mortgage is that what it's done is the people that have owned rental properties for numerous years, say 15, 20, 25, 30 years. Some people have owned rental properties for, decades upon decades, and they're getting older, they want to get out of the business, and these properties they don't owe any money on. So it's very easy at this point to set up an owner finance deal. They're not taking a full-on cash payment for these properties, which they're going to take a tax hit for. Capital gains tax that they're going to have to pay on this lump sum of money that comes in. They like, getting their landlords. They've been doing it for a while. They like getting a check every month, and they're obviously not in a financial need where they have to unload and collect all their cash at this point. So this is an ideal person for this type of strategy, do an owner finance. Basically, on an owner finance property, if they have a package of properties, 4, 5, 6, 7, 8 of them, somebody's not going to have, $400,000 or $300,000 to just dump into these properties. There are people out there that can do that. Typically, someone who's going to buy this doesn't really have the funds, or doesn't want to tie up the funds because they're doing other things with that money. So basically, when you come into an owner finance situation, there's some key factors into this. Obviously, the less money you have to put up front, is better. Typically what I like to tell everyone is you'll see this on a rental property analysis spreadsheet that I have, but basically just a rule of thumb. Some people say I want 1% of the cost of house, annually, on a monthly basis, or 2% monthly, they're their rule of thumb. That is great, that's a good figure, and sometimes it works a lot. Typically what I want to see is I want my mortgage payment to be 40 to 50% of what the rental income is going to be every month. And if you use that formula, it actually works out better. You generate more cash flow this way. And cash flow, again, is the name of the game. So as you're building your passive income through your rental properties, if you keep that in mind, that you have a 40 to 50% loan payment versus what your rent payment is coming in. So for round numbers, if you have $1,000 a month rental property, you want to pay $400 to $500 a month, and this should include your principal as well as your interest. And remember that these people aren't a bank; they are an individual. So you can structure this note to meet these guidelines. And what I tell everyone is don't get in a deal that where you're it's a $500 a month rental property. And that's what you're generating on a monthly basis, and you're paying $400. That's going to be a negative cash flow property. Sometime through that process, somebody is going to flush paper towels down the toilet. The house is going to need to get painted. There's just numerous problems you run into with having tenants, and that's just the fact of the business. You're going to have to pay your handyman or your contractor or somebody to go out there and fix it, unless you like handling a plunger and going in plunging a clogged toilet at 2:30 in the morning. Me personally, I would rather be asleep than unclogging someone's toilet. So don't be fooled by using a different formula. This is the safest formula to use. If you can't negotiate the deal to those terms, I would suggest you just walk away. Now, on the other hand, there are some investors that preach about buying property for appreciation. What it will be 10 years, 15 years from now, the value is what you're kind of banking on at some point to sell, that's a real estate play that a lot of people do use. Me personally, I'm not banking on that because we don't know what the future holds. I want cash, in 30 days, and then 30 days after that, and 30 days after that. I want my money coming in on a monthly basis so I can get back my down payment, or if I purchase the property outright, I get my money back as fast as possible. So those are just a few overviews on our rental properties. I'm going to step to another portion of it where I see a lot of people teaching how to obtain property or take control of the property through a contract or through terms, as they, hide that in the documents. Here's the problem with that. When you don't do a closing on a property, the likelihood of you getting a title search done is slim to none. You're also not going to get title insurance on this property. So if I was to, accumulate a property through, I don't know, John Smith Incorporated, he's got a portfolio of properties, he's tired of dealing with them, I come in and do, a terms issue with him. Well, there's a few important factors that I don't know. A, are there any liens on the property? This guy could be going through some sort of crisis. He could have tax liens, contractor liens. I mean, it can go on and on and on. He could have had something like a personal accident, had a judgment, and it attached to one of his properties. You never know. This, to me, is a huge red flag, and in most states, you have to make sure that you're actually abiding by state law when you're taking control of these properties. I strongly advise people not to do this. You don't know if the owner's going to pay the mortgage. So then you're caught in the middle of a situation where you have control of a property, but it's going into foreclosure because when you pay your payment back to the original owner, he might not be paying the mortgage. You have a tenant in place. It just gives you a lot of liability that I feel is not very risk versus reward. There's not as much reward for the risk you're kind of putting yourself into in the situation. With that being said, I think that this no money, I buy houses on terms kind of thing is somewhat amateur. It sounds great. It's a really great thing to sell you, my ideas about, but just in a first-hand account, it's really not a good idea to do it. I try to tell everyone, if you want to go through the owner financing portion of it, that's very good. Obviously, there's a couple things you want to consult your attorney in your state regarding this, but here in North Carolina, typically what we do is we want to have either entity, which is LLC, S Corp, however you structure your company, to another LLC or S Corp, or someone personal to a corporation. Never do a owner finance note or any kind of note from individual to individual. Then you're going to get into federal housing regulation and a whole bunch of headache that most mortgage lenders have to go by. And again, you don't want to get in a situation where there could be legal issues. It's just a huge headache. I've been there, done that, and it's not worth it. That's why I say in other videos that pretty much, I'm telling you things that I've done and I know that work, and even if they sound great, when someone else is telling you this, the fact of the matter is in most states you actually can't do this, and it also sets you up for a huge risk and a huge liability in the future. So the terms type deal, to me, I would just take off running as fast as you can. Do an owner finance deal. That's a very good way to accumulate property with a little bit of money down. You actually are deeded the property, you actually have title insurance on the property. So you're technically the owner. The person you purchased it from is the lien holder or the mortgage holder. So you're in a way better position to control that property that way. It's a much cleaner way to do it, and it's a safer way to do it, especially if you really want to take your business serious and accumulate wealth through your passive income. So let's get back and recap on all that. Terms, deals, don't do it. Like I said before, these people suggest these great scenarios where you give them this and then you're getting $100 a month for taking control of the property. It's wrong. If your payment back to whoever you're getting the house from is more than 50%, walk away from it. You're not, by the time you pay taxes, insurance, any repairs, you're going to net negative. And that's kind of pointless. I mean, if you want to lose money on a property every month, it's kind of no point of being in business. You want to generate cash off of that property. So with that being said, at the 50% rule, you're probably going to just roughly have anywhere from 20 to 25%, maybe 30 at the worst case scenario. So you're still netting 20% on a monthly basis as long as that property stays rented. And another rule I use when I'm doing my calculations is basically take it off an 8-month rental. So that gives you 4 months, a quarter out of the year where the property is vacant. 9 times out of 10, they don't sit there that long if you can market them and get people in the house. But again, that's a conservative way to look at your investments, because if you're always doing a conservative takeoff on what you're going to get, you're usually always going to be cash flow positive. So recapping on that, we want to do owner finance properties, or if you can pay cash for them, pay cash for them. We haven't got to the next method of buying property, but those are two great methods, obviously, to use. Owner finance has come real big in the last couple of years. Well, I mean, it's been big for a long time, but now since the banks are cutting back, it's become even more prevalent that people can't sell the property.